There is a number so vast it defies easy comprehension, the total of all the world's debt, public and private. This figure has grown relentlessly, shaping nations and individuals alike. From government halls in Washington to households in Beirut, this ocean of debt connects us all. It's a story of promises made, obligations deferred, and a future written one loan at a time. Understanding how we arrived here means looking back at the turning points that changed everything. This is not just an academic exercise, it's a journey into the mechanics of our global system now at a crossroads. The scale is staggering, measured in trillions, but its effects are real, from the price of bread to the stability of the global financial system. When governments, corporations, or individuals borrow, they're making promises about the future. But what happens when those promises become too large, or the future doesn't deliver? We'll trace the origins of our predicament, from the US in the 1970s to Sri Lanka in the 2020s. This is not a story of blame, but of understanding, mapping the currents of this great ocean of debt. Where have they come from, and where might they take us next? For centuries, the world's financial system was anchored by gold. Under the gold standard, a nation's currency was tied to a specific amount of gold, limiting how much money could be printed. This system provided stability and discipline, but by the mid-20th century, it was under strain. The US dollar, the world's reserve currency, faced pressure from war costs and social programs. Foreign countries began to doubt America's gold reserves. In August 1971, President Nixon stunned the world. The US would no longer convert dollars to gold. The Bretton Woods system was over. Money was now backed only by government promise, fiat currency. Governments and central banks gained new flexibility to manage economies but lost a critical check on borrowing. Now, deficits could be financed by simply creating more money. This decision didn't create the debt spiral, but it opened the door. The world entered an era of unprecedented credit and debt expansion. The link between money and gold was severed, forever changing the nature of debt. The consequences would ripple for decades. The stage was set for a new financial world, one with far fewer limits. The 1970s began with money unmoored from gold, and new storms quickly followed. In 1973, the oil embargo by OPEC sent crude prices soaring, shocking economies built on cheap energy. Inflation surged worldwide. The cost of living and doing business skyrocketed. Stagflation, stagnant growth, and high inflation became the new reality. Governments borrowed to subsidize energy and support industries, while oil-rich nations deposited petrodollars in Western banks. Banks, flush with cash, lent heavily to developing countries, especially in Latin America. This recycling of capital seemed like a solution, but it planted seeds for future crises. The precedent was set: governments used debt to paper over deep problems rather than make tough reforms. By the decade's end, inflation was entrenched, growth was weak, and global debt had ballooned. The world was more interconnected and more vulnerable than ever. A single shock could now trigger global instability. The cycle of crisis, inflation, and borrowing had begun. The debt spiral was accelerating. The 1980s brought a revolution in economic thinking, led by Reagan and Thatcher. Their message: government was the problem, not the solution. The answer? Free markets, deregulation, and tax cuts. Financial rules from the Great Depression were dismantled, unleashing a wave of innovation and risk. Banks could now take bigger risks and expand globally. Meanwhile, U.S. government debt soared as tax cuts and military spending outpaced revenues. The theory was that growth would close the gap, but deficits only widened. Debt became a commodity, packaged, traded, and speculated upon. The financial sector grew in size and influence, fueling a credit boom. The foundations of the global system were shifting, setting the stage for future crises. The seeds of a debt-dependent, volatile economy were sown. The deregulated global system faced its first major tests in the 1990s. The Asian financial crisis began in Thailand in 1997, spreading panic across the region. Foreign capital fled, leaving behind collapsed banks and mountains of bad debt. The IMF stepped in with bailout loans but demanded harsh spending cuts, deepening the pain for ordinary people. The ultimate test came in 2008, starting with risky U.S. subprime mortgages. When the housing bubble burst, losses cascaded worldwide. Lehman Brothers collapsed, credit markets froze, the world teetered on the edge of another Great Depression. Governments and central banks responded with trillions in bailouts and stimulus, slashing interest rates to near zero. The worst was averted, but at a cost. Public debt soared to levels not seen since World War II. Private bank debts became public burdens. The world was saved from one crisis by creating the conditions for the next. Slow growth and even greater reliance on debt followed. The debt spiral tightened its grip. Then came COVID-19, a crisis not of finance but of public health. Economies ground to a halt. Millions lost jobs overnight. Governments responded with unprecedented spending, direct payments, expanded benefits, massive business loans. Central banks printed money on a colossal scale, buying government bonds. Quantitative easing. Global debt, already high, exploded. The stimulus worked. Economic collapse was averted. Families and businesses were saved. But with supply chains broken and money flooding the system, inflation returned with a vengeance. Central banks reversed course, raising interest rates at record speed to fight inflation. The result, a painful squeeze for families and nations alike. Borrowing costs soared, especially for countries like Sri Lanka and Lebanon, leading to economic collapse and human suffering. The pandemic response pulled the world back from one cliff, only to push it closer to another. The debt spiral had become a defining force in everyday life. The world was now more indebted, and more fragile, than ever. Today, in 2025, we stand at a crossroads. The global debt spiral has brought us here, through historic decisions, crises, and policy choices. Each intervention has added another layer to the complex structure of global obligations. We see the effects in persistent inflation, rising interest rates, and the struggles of nations and families alike. The tools of the past, stimulus, low rates, are losing their power. Raising rates risks recession. Failing to control inflation risks unrest. We are caught between promises that may be impossible to keep. Can this mountain of debt ever be repaid? Or must it be inflated away, defaulted on, or forgiven? What new systems might create a more stable, equitable world? The story of the debt spiral is far from over. We are all living in its next chapter.